Welcome to Module 8. Today we are focusing on multi-timeframe and multi-factor analysis. This is where we move beyond simple patterns and start looking at the market as a complex, interconnected system. Our objectives for today are 1. Master top-down multi-timeframe analysis. 2. Build a Confluence-based trading checklist. 3. Integrate India-specific sentiment and positioning data. And 4. Understand intermarket correlations. By the end of this session, you will be able to align different timeframes to increase your win rate, identify true confluence, and use Indian market data like PCR and FII positioning to filter your trades. We are going to start with the multi-timeframe framework, often called top-down analysis. This is perhaps the most important skill for a professional trader because it ensures you aren't fighting the big money. To trade successfully, you must understand that the market exists in multiple dimensions of time simultaneously. We use a three-tier hierarchy to organize our thoughts. Think of the higher time frame, like the daily or weekly chart, as the tide of the ocean. It tells us the overall direction or bias. Are we in a bull market or a bear market? The mid-time frame, specifically the 1-hour chart, shows us the structure. This is where we see the waves, the support and resistance levels that define the current playing field. Finally, the lower time frame, such as the 5 or 15-minute chart, is our entry trigger. This is where we look for the specific ripple that signals it is time to jump in. The most common reason good-looking setups fail is trading against the higher time frame bias. A perfect 5-minute breakout will often trap you if the daily chart is hitting a major resistance level. Let's walk through a practical example using the Nifty 50 index to see how these layers interact. First, we look at the daily chart. If Nifty is making higher highs and higher lows, our bias is strictly bullish. We are only looking for reasons to buy. Next, we drop to the 1-hour chart. We are looking for the market to pull back to a structural level, perhaps a previous breakout point that should now act as support. We mark this key zone. Finally, we zoom into the 5-minute chart once price hits that 1-hour zone. We don't just buy blindly, we wait for an entry trigger like a bullish engulfing candle or a change in local market structure. By aligning all three, you ensure that the tide of the daily trend is at your back when you take that small wave on the 5-minute chart. Now that we understand timeframes, let's talk about building a checklist using the concept of confluence. Confluence is the secret sauce of high-probability trading. It occurs when at least 3 independent factors align at the same price point. However, many traders make the mistake of using redundant indicators. If you use RSI and stochastics together, you aren't getting 2 signals. You're getting 2 versions of the same signal because they are highly correlated. They both measure momentum. True confluence comes from combining different types of data. For example, combining price action, which is a leading indicator, with volume, which shows conviction, and then adding a mathematical level like VWAP or a derivative data point like open interest. Here is a sample checklist you might use. 1. Higher time frame trend for daily bias. 2. Key zones like support or resistance. 3. Volume confirmation. 4. Open interest data. And 5. The position relative to VWAP. Take a moment to think about your current strategy. Are you looking at 3 different ways to say the same thing? Or are you looking for truly independent confirmation? You should build your own checklist based on what you have backtested, not just copy one you saw online. For Indian traders, price action is only half the story. To truly understand the market, we must look at sentiment and positioning data, which is published daily by the National Stock Exchange. We focus on 4 key India-specific data points: the put-call ratio, max pain, FII and DII activity, and the India VIX. The put-call ratio, or PCR, tells us the mood of the options market. A very high PCR often indicates the market is oversold and due for a bounce, while a very low PCR suggests extreme optimism and a potential top. Here is the PCR scale. Less than 0.7 suggests an overbought market with bearish reversal potential. Greater than 1.4 indicates an oversold market with bullish reversal potential. Max pain is the strike price where option buyers would lose the most money. The market often gravitates toward this level near expiry. We also track FII and DII data. Foreign institutional investors, or FIIs, are the big movers. We don't just look at their net buying or selling in the cash market, we look at the index futures long-short ratio. If FIIs are 80% short on futures, you should be very careful about taking long positions, regardless of what the 5-minute chart says. Finally, keep an eye on the India VIX, our fear gauge. When VIX is below 15, volatility is low and trending strategies work well. But when VIX is above 20, expect high volatility, wild swings, and stop-loss hunting. When VIX is elevated, you should reduce your position size and widen your stop-losses, or avoid certain breakout strategies altogether. Now, let's look at intermarket and correlation analysis. No market is an island, especially not the Indian market. We need to understand how external forces and internal divergences shape price action. We focus on 3 primary factors: Nifty versus Bank Nifty divergence, the influence of U.S. markets like the Dow and Nasdaq, and global macros like the dollar index and crude oil. A key internal signal is the divergence between Nifty and Bank Nifty. Since banking is the largest heavyweight sector in Nifty, they usually move together. If you see Nifty making a new high, but Bank Nifty is struggling to move up, or even making lower highs, that is a massive warning sign. It suggests the rally is not broad-based and lacks the muscular support of the banks. This often leads to a failed breakout in Nifty. We also have to consider the overnight influence of U.S. markets. Because the Indian market opens after the U.S. close, the performance of the Dow Jones and Nasdaq futures often dictates our opening gap. If the Nasdaq is down 2% overnight, Nifty will likely gap down. The real skill is determining if that gap will be filled or if it will lead to a trending day. Now let's look at global macro correlations. Strength in the US dollar index, or DXY, is often bearish for emerging markets like Nifty. When the DXY strengthens, capital often flows out of emerging markets and back into the US. Similarly, because India imports most of its oil, rising crude prices put pressure on the rupee and corporate margins, acting as a headwind for Nifty. Always check these 2 before your trading day begins. Thanks for watching this module on correlations. Finally, let's explore sector rotation. Money in the market is like water. It flows from one place to another. Smart money often moves into specific sectors before the broader Nifty index starts its move. The Indian market is divided into various sectoral indices, such as Nifty IT, Nifty Pharma, Nifty FMCG. By comparing sectoral indices to the Nifty 50, we can identify relative strength. If the Nifty is sideways but the auto sector is breaking out to all-time highs, the auto sector is showing relative strength. This is where you should be looking for individual stock picks. The relative strength ratio is calculated as the sector index divided by the Nifty 50 index. When this ratio is rising, the sector is outperforming the market. Often, a rally starts in 1 or 2 lead sectors, and as those stocks become expensive, investors rotate their money into lagging sectors that are still cheap. Think about it this way. If you see the IT sector starting to surge while the rest of the market is quiet, it's a leading indicator that overall market sentiment might be turning positive. Tracking these rotations helps you stay ahead of the curve, rather than just reacting to Nifty's movements after they've already happened. Let's recap our learning goals. 1. Top-down analysis, daily bias, hourly structure, and 5-minute entry. 2. Confluence, using 3 or more independent factors to confirm setups. 3. India data, leveraging PCR, FII data, and VIX as filters. 4. Correlations, monitoring Nifty and Bank Nifty divergence and global macro. We have now covered the framework for multi-timeframe and multi-factor analysis. You've learned how to align timeframes to avoid traps, build a robust checklist using independent Confluence, and layer in India-specific data and global correlations. In the next module, we will dive deeper into risk management and how to size your positions based on the strength of the Confluence you've identified today. Spend some time this week looking at the NSE website and identifying these data points for yourself. Happy trading!